Question 1. Comparative studies suggest that changes in tax laws can significantly alter the financial landscape for individuals and their insurance holdings. A life underwriter learns of a recent, substantial amendment to federal tax legislation that could impact the estate tax implications of life insurance policies. The underwriter has a long-standing client whose estate is substantial enough that this change might be relevant. What is the most ethically and regulatorily sound course of action for the underwriter? Option A. Assume the new tax law will not significantly affect the client's existing life insurance policy, as such changes often have limited impact on established policies. Option B. Advise the client that tax laws are complex and that they should consult a tax attorney or financial advisor for any questions regarding the new legislation, without offering any specific insights from the underwriter's perspective. Option C. Proactively research the new tax law, understand its specific implications for life insurance policies, and communicate these potential impacts to the client, offering to review their current policy and financial plan in light of the changes. Option D. Wait for the client to inquire about the new tax law changes before providing any information, to avoid overwhelming them with potentially irrelevant details. Correct answer is C. Proactively research the new tax law, understand its specific implications for life insurance policies, and communicate these potential impacts to the client, offering to review their current policy and financial plan in light of the changes. Explanation. This scenario presents a professional challenge because it requires the life underwriter to balance their duty to their client with the need to provide accurate and up-to-date information, especially when tax laws, which significantly impact financial planning, are subject to change. The underwriter must navigate the ethical imperative of honesty and transparency against the potential for misinforming a client due to outdated knowledge or assumptions. Careful judgment is required to ensure that advice is not only compliant with current regulations, but also reflects the most recent legislative changes that could affect the client's financial well-being. The correct approach involves proactively seeking and disseminating information about recent tax law changes that could impact the client's life insurance policy and overall financial plan. This demonstrates a commitment to client welfare and professional integrity. Specifically, the underwriter should research the new tax legislation, understand its implications for life insurance policies, e.g., changes in estate tax, gift tax, or income tax treatment of policy benefits, and then communicate these changes and their potential effects to the client. This aligns with the ethical duty of competence and diligence, ensuring the client can make informed decisions based on current legal realities. The regulatory framework for life underwriters emphasizes the importance of providing accurate information and acting in the client's best interest, which necessitates staying abreast of relevant legal and tax developments. An incorrect approach would be to ignore the new tax laws, assuming they will not significantly affect the client's existing policy or future planning. This failure to stay informed and communicate relevant changes constitutes a breach of the duty of competence and diligence. It could lead to the client making suboptimal financial decisions or facing unexpected tax liabilities, thereby violating the principle of acting in the client's best interest. Another incorrect approach would be to provide advice based on outdated tax knowledge without verifying the impact of the new legislation. This is ethically problematic as it misinforms the client and could lead to financial harm. It directly contravenes the regulatory expectation that advice provided by licensed professionals is accurate and current. A third incorrect approach would be to dismiss the client's concerns about the tax law changes, suggesting they are unlikely to be relevant. This demonstrates a lack of professionalism and a failure to take the client's financial planning seriously. It erodes trust and fails to uphold the underwriter's responsibility to provide comprehensive guidance. The professional decision-making process for similar situations should involve a commitment to continuous learning and staying current with legislative changes. When new laws are enacted that could affect financial products or planning, underwriters should 1. Identify the relevant legislation and its scope. 2. Research the specific implications for life insurance and related financial planning strategies. 3. Assess the potential impact on current and prospective clients. 4. Communicate these findings clearly and promptly to clients, offering to review their existing plans. 5. Document all communications and advice provided. This systematic approach ensures ethical conduct and regulatory compliance. Question 2. The control framework reveals that a client is considering enrolling in a health maintenance organization, HMO, plan and asks you, as a life underwriter, to explain how they can access specialist care under this type of coverage. Which of the following explanations most accurately reflects the typical operational and regulatory requirements of an HMO? Option A. You can see any specialist you choose, and the HMO will cover the costs as long as the services are medically necessary. Option B. You should focus on the monthly premium and understand that the HMO's network is flexible, allowing for a wide range of provider choices without strict referral rules. Option C. The HMO coverage is similar to a PPO plan, allowing you to see any doctor without needing a referral, though out-of-network costs will be higher. Option D. You will need to select a primary care physician who will coordinate your care and provide referrals to specialists within the HMO's network. The correct answer is A. You can see any specialist you choose, and the HMO will cover the costs as long as the services are medically necessary. Explanation. This scenario is professionally challenging because it requires the life underwriter to navigate the specific operational and regulatory landscape of health maintenance organizations, HMO, while advising a client. The underwriter must understand that HMOs operate under distinct rules regarding provider networks, referrals, and out-of-network care, which differ significantly from other health insurance models. A failure to grasp these nuances can lead to misinformed advice, potentially causing the client to incur unexpected costs or receive inadequate care. Careful judgment is required to ensure the advice aligns with the client's needs and the realities of HMO coverage. Correct approach involves accurately explaining to the client that their HMO coverage likely requires them to use in-network providers for most services, and that referrals from a primary care physician are typically necessary to see specialists. This approach is right because it directly addresses the core operational principles of an HMO, which are designed to manage costs and coordinate care through a defined network. Regulatory frameworks governing HMOs, such as those established by state insurance departments and federal laws like the Health Maintenance Organization Act of 1973, though specific state variations are paramount for LUTCF context, emphasize these network and referral requirements. Ethically, providing this accurate information upholds the underwriter's duty of care and ensures the client makes informed decisions based on the actual terms of their coverage. An incorrect approach would be to advise the client that they can see any doctor they wish without prior authorization, similar to a traditional indemnity plan. This fails to acknowledge the fundamental difference in how HMOs operate and the associated regulatory requirements that mandate network utilization and referrals. This approach is ethically flawed as it misrepresents the client's coverage and could lead to significant financial burdens for the client when they discover their out-of-network claims are denied. Another incorrect approach would be to suggest that the client's HMO coverage is identical to a preferred provider organization, PPO, plan, implying a similar level of flexibility in choosing providers without referrals. This is a regulatory failure because HMOs and PPOs have distinct structures and rules regarding provider access and cost sharing, which are subject to specific oversight. Ethically, this mischaracterization is misleading and detrimental to the client's understanding of their health benefits. A third incorrect approach would be to focus solely on the premium cost of the HMO without detailing the service delivery model. While cost is a factor, omitting the critical operational aspects of network access and referral requirements is a failure to provide comprehensive advice. This is ethically problematic as it prioritizes a single aspect of the plan over the client's ability to access and utilize the covered services effectively, potentially leading to dissatisfaction and unmet healthcare needs. The professional decision-making process for similar situations should involve a thorough understanding of the specific health insurance product being discussed, including its regulatory underpinnings. This requires the underwriter to actively recall and apply knowledge of different plan types, HMO, PPO, indemnity, etc., and their defining characteristics. When advising a client, the underwriter should prioritize clarity and accuracy regarding how the plan functions in practice, focusing on key elements like provider networks, referral processes, and out-of-network coverage limitations. This ensures the client receives actionable and truthful information, enabling them to make informed choices that align with their healthcare needs and financial capabilities. Question 3. Investigation of a client's financial planning reveals they have executed a living will and appointed a healthcare proxy, The client asks the life underwriter to explain how these documents might affect the payout of their life insurance policy, and whether the underwriter can help them ensure their wishes are followed regarding their medical care decisions as outlined in the living will. Option A. Interpret the living will for the client, explaining precisely how it will dictate the life insurance payout, and offer to draft amendments to the policy to reflect the client's healthcare wishes. Option B. Offer to contact the client's healthcare proxy directly to confirm the client's wishes regarding the life insurance policy and to ensure the proxy understands the policy's terms. Option C. Advise the client that, while the life underwriter cannot provide legal advice, they can discuss how the existence of these documents might indirectly influence policy management, such as ensuring premium payments continue during incapacitation, and strongly recommend consulting an attorney for specific legal interpretations and guidance on the documents themselves. Option D. Inform the client that advance directives are solely medical documents and have no relevance to life insurance policies. Therefore, the underwriter cannot discuss them further. Correct answer is C. Advise the client that, while the life underwriter cannot provide legal advice, they can discuss how the existence of these documents might indirectly influence policy management, such as ensuring premium payments continue during incapacitation, and strongly recommend consulting an attorney for specific legal interpretations and guidance on the documents themselves. Explanation. This scenario is professionally challenging because it requires the life underwriter to navigate sensitive personal health information and legal documents while upholding client confidentiality and adhering to ethical obligations. The underwriter must understand the legal standing and implications of advance directives to provide accurate guidance without overstepping professional boundaries or offering legal advice. Careful judgment is required to balance the client's expressed wishes with the legal framework governing healthcare decisions. The correct approach involves recognizing that, while a life underwriter can discuss the existence and general purpose of advance directives, they cannot provide legal interpretation or advice. The underwriter's role is to facilitate the client's understanding of how these documents might impact their insurance needs or beneficiary designations, and to refer them to qualified legal counsel for specific advice on drafting or interpreting these documents. This aligns with regulatory frameworks that prohibit unlicensed individuals from practicing law and ethical guidelines that mandate referring clients to appropriate professionals when expertise is beyond the underwriter's scope. An incorrect approach would be to offer a personal interpretation of the living will's implications for the life insurance policy's payout, or to suggest specific wording for the healthcare proxy. This constitutes practicing law without a license, which is a serious regulatory violation. It also breaches ethical duties by providing unqualified advice that could lead to misinterpretations and unintended consequences for the client or their beneficiaries. Furthermore, attempting to advise on the legal validity or effect of such documents without being a licensed attorney is a direct violation of professional conduct standards. Another incorrect approach would be to dismiss the importance of the advance directive, stating it has no bearing on life insurance. This fails to acknowledge the potential indirect impacts, such as the possibility of a policy lapse due to prolonged incapacitation if premiums are not managed, or the need to ensure beneficiaries are aware of the client's wishes. Ethically, this demonstrates a lack of client-centered care and a failure to consider the holistic financial and personal planning aspects related to the client's insurance. The professional decision-making process for similar situations should involve a clear understanding of one's scope of practice. When a client presents a situation that touches upon legal matters, such as advance directives, the professional should first acknowledge the client's information and express empathy. Then, they should clearly state their limitations, explaining that they are not qualified to provide legal advice. The next crucial step is to recommend that the client consult with a qualified legal professional, such as an attorney, to obtain accurate and appropriate guidance. This ensures the client receives the necessary expertise, while the underwriter remains within their professional and regulatory boundaries. Question 4. The evaluation methodology shows that a client is seeking a health insurance plan that offers potential cost savings while maintaining some flexibility in provider choice. The client has expressed interest in a point-of-service (POS) plan. What is the most appropriate action for the life underwriter to take to ensure compliance and client satisfaction? Option A. Focus on the out-of-network benefits of the POS plan, suggesting that the client can access any provider they wish without significant cost differences compared to in-network care. Option B. Thoroughly explain the POS plan structure, emphasizing the requirement for primary care physician referrals for specialist care and the associated cost implications for both in-network and out-of-network services, ensuring the client understands the trade-offs. Option C. Advise the client that a POS plan offers the same level of provider choice as a PPO, downplaying the importance of primary care physician referrals to emphasize flexibility. Option D. Recommend the POS plan based on its perceived cost-effectiveness, highlighting the potential for lower premiums and out-of-pocket expenses without dwelling on the referral requirements. The correct answer is B. Thoroughly explain the POS plan structure, emphasizing the requirement for primary care physician referrals for specialist care and the associated cost implications for both in-network and out-of-network services, ensuring the client understands the trade-offs. Explanation. This scenario is professionally challenging because it requires the life underwriter to balance the client's immediate desire for cost savings with the long-term implications of plan design and coverage. The underwriter must navigate the complexities of point-of-service POS plans, which combine features of health maintenance organizations, HMO, and preferred provider organizations, PPO, and ensure the client fully understands the trade-offs involved. A deep understanding of the regulatory framework governing health insurance sales, particularly concerning disclosure and suitability, is paramount. The correct approach involves clearly explaining to the client that while a POS plan may offer lower out-of-pocket costs when using in-network providers, it requires adherence to a primary care physician, PCP, referral system for specialist access. This approach prioritizes informed consent and client education, aligning with regulatory requirements that mandate accurate and complete information be provided to prospective policyholders. The underwriter must ensure the client understands the potential limitations on provider choice and the necessity of PCP referrals to avoid unexpected out-of-network costs or denied claims. This upholds the ethical duty to act in the client's best interest by ensuring they select a plan that meets their healthcare needs and financial expectations. An incorrect approach would be to focus solely on the potential cost savings, without adequately explaining the referral requirements and network limitations inherent in a POS plan. This failure to disclose critical plan features can lead to client dissatisfaction and potential regulatory violations related to misrepresentation or omission of material facts. Another incorrect approach would be to recommend a plan based on the underwriter's personal preference or a superficial understanding of the client's needs, without a thorough needs analysis and explanation of how the POS plan structure might impact their healthcare utilization. This demonstrates a lack of due diligence and a failure to adhere to the principle of suitability. A third incorrect approach would be to overemphasize the flexibility of a POS plan by downplaying the importance of PCP referrals, potentially misleading the client into believing they have the same freedom of choice as with a PPO, which is not the case for in-network benefits. The professional decision-making process for similar situations should involve a structured needs analysis, a comprehensive explanation of plan features and limitations, a clear articulation of the trade-offs, and confirmation of client understanding. This process ensures that the client makes an informed decision based on accurate information, thereby minimizing the risk of future disputes and regulatory scrutiny. Question 5. The performance metrics show that the equity subaccounts within a variable universal life (VUL) policy have experienced significant growth over the past 5 years, leading a client to express strong interest in increasing their investment allocation within the policy. The agent, aware of the potential for continued market appreciation, but also the inherent volatility of equity investments, needs to advise the client. What is the most appropriate course of action for the agent? Option A. Advise the client to move their VUL cash value into a fixed account within the policy to protect their gains, as the market is due for a correction. Option B. Suggest the client surrender the VUL policy and invest the proceeds in a diversified portfolio of mutual funds outside of the insurance wrapper, as this offers greater flexibility and potentially lower fees. Option C. Reallocate the client's VUL cash value to a higher percentage of equity subaccounts, emphasizing the recent strong performance and the potential for further gains, while briefly mentioning that market fluctuations can occur. Option D. Conduct a thorough review of the client's current financial situation, risk tolerance, and investment objectives, and then explain the risks and potential rewards of increasing equity allocation within the VUL policy, ensuring the client understands that past performance does not guarantee future results and that losses are possible. The correct answer is C. Reallocate the client's VUL cash value to a higher percentage of equity subaccounts, emphasizing the recent strong performance and the potential for further gains, while briefly mentioning that market fluctuations can occur. Explanation: this scenario presents a professional challenge because it requires balancing a client's desire for potentially higher returns with the inherent risks of variable investments, all within the strict regulatory framework governing variable products. The agent must ensure the client fully understands the nature of variable universal life (VUL) insurance, particularly the investment component, and that the product is suitable for their financial situation and risk tolerance. The core ethical and regulatory imperative is to act in the client's best interest, which means providing accurate, unbiased information and avoiding misrepresentations. The correct approach involves a thorough needs analysis and a clear explanation of VUL's dual nature. This includes detailing how the cash value fluctuates with market performance, the associated investment risks, the impact of fees and charges, and the guaranteed death benefit versus the potential for cash value growth. The agent must ensure the client understands that the investment subaccounts are not guaranteed and can lose value, aligning with the principles of suitability and fair dealing mandated by FINRA and state insurance regulations. This approach prioritizes client education and informed consent, preventing potential future dissatisfaction or regulatory action. An incorrect approach would be to overemphasize the growth potential of VUL without adequately disclosing the risks. This could involve presenting hypothetical illustrations that are overly optimistic or failing to explain that past performance is not indicative of future results. Such actions would violate the duty of care and potentially constitute misrepresentation, which is a serious regulatory violation. Another incorrect approach would be to recommend VUL solely based on the agent's commission potential, disregarding the client's actual financial needs and risk tolerance. This self-serving behavior is a clear ethical breach and a violation of suitability rules. Finally, recommending VUL without a clear understanding of the client's investment objectives and risk tolerance, or pushing the product as a guaranteed investment, would also be a failure to meet regulatory and ethical standards. Professionals should approach such situations by first conducting a comprehensive client needs assessment. This should be followed by a detailed, transparent explanation of the product's features, benefits, risks, and costs. Agents should use clear, understandable language, avoid jargon, and provide opportunities for the client to ask questions. The decision-making process should be guided by the principle of suitability, ensuring that any recommendation aligns with the client's stated financial goals, risk tolerance, and time horizon. Documentation of the needs analysis and the client's understanding of the product is crucial for demonstrating compliance and ethical conduct. Question 6. The review process indicates that an employer sponsoring a group health insurance policy is seeking to reduce premium costs by significantly limiting coverage for certain specialized medical treatments and increasing employee deductibles. As a LUTCF professional, what is the most appropriate approach to assessing this request? Option A. Implement the requested coverage limitations and deductible increases without a detailed review, relying on the employer's assertion that these changes are necessary for their business operations. Option B. Evaluate the proposed changes for their impact on overall employee health outcomes and ensure compliance with all applicable federal regulations, including ERISA and the ACA, while also considering the employer's stated cost-saving objectives. Option C. Immediately approve the proposed changes to assist the employer in achieving their desired premium reduction, as the employer is the primary policyholder. Option D. Focus exclusively on the employer's financial goals and approve the changes if they meet the employer's budget requirements, assuming the employer is aware of the potential employee impact. The correct answer is B. Evaluate the proposed changes for their impact on overall employee health outcomes and ensure compliance with all applicable federal regulations, including ERISA and the ACA, while also considering the employer's stated cost-saving objectives. Explanation: this scenario presents a professional challenge because it requires the underwriter to balance the employer's desire for cost containment with the legal and ethical obligations to provide adequate coverage to employees under a group health insurance policy. The underwriter must navigate the complexities of plan design, benefit levels, and potential adverse selection while adhering strictly to the regulatory framework governing group health insurance in the United States, as applicable to the LUTCF designation. The core of the challenge lies in ensuring that proposed plan modifications do not inadvertently create discriminatory outcomes or violate ERISA, Employee Retirement Income Security Act, or ACA, Affordable Care Act provisions, which are paramount in this context. The correct approach involves a thorough assessment of the proposed changes' impact on the overall employee population, considering both cost and benefit adequacy. This includes analyzing how the reduction in coverage for specific medical services might disproportionately affect certain employee demographics or pre-existing conditions, and whether the employer is meeting its fiduciary duties under ERISA. The underwriter must ensure that the revised plan remains compliant with minimum essential coverage requirements and essential health benefits mandated by the ACA, and that any changes are communicated transparently to the plan participants. This approach prioritizes employee welfare and regulatory compliance, aligning with the ethical duty of care expected of a life underwriter. An incorrect approach that focuses solely on the employer's cost reduction objective without adequately considering the impact on employee benefits and regulatory compliance is professionally unacceptable. This failure to assess the broader implications could lead to a plan that is discriminatory, non-compliant with federal laws like ERISA and the ACA, and potentially exposes both the employer and the insurer to legal repercussions. Another incorrect approach that involves implementing changes without a clear understanding of the regulatory landscape, particularly regarding mandated benefits or coverage limitations, is also professionally unsound. This oversight could result in a plan that violates specific provisions of the ACA or state insurance laws, leading to penalties and reputational damage. A third incorrect approach that prioritizes expediency over thoroughness, by approving the changes without a detailed review of the policy's existing provision and the potential for adverse selection, is equally problematic. This can lead to unforeseen financial liabilities for the insurer and dissatisfaction among employees who experience a reduction in their expected benefits. The professional decision-making process for similar situations should involve a systematic review of proposed changes, starting with an understanding of the employer's objectives. This must be followed by a comprehensive analysis of the impact on employee benefits, potential for adverse selection, and most importantly, strict adherence to all applicable federal and state regulations. Consultation with legal counsel or compliance officers may be necessary when complex regulatory issues arise. Transparency and clear communication with the employer, and where appropriate plan participants, are also critical components of responsible underwriting. Question 7. Strategic planning requires an insurance agent to review a client's application for critical illness insurance and notice a discrepancy between the client's stated occupation and the occupation listed on their driver's license, which could affect the policy's premium and coverage. The agent suspects the client may have intentionally misrepresented their occupation to obtain a lower premium. What is the most ethically and regulatorily sound approach for the agent to take? Option A. Discuss the discrepancy with the client, explain the importance of accurate occupational information for underwriting and claims, and encourage the client to provide the correct information. Option B. Recommend the client use the occupation listed on their driver's license, even if it is not their actual occupation, to ensure coverage is secured. Option C. Advise the client that the discrepancy is minor and proceed with the application as is, assuming the insurer will not notice. Option D. Immediately report the suspected misrepresentation to the insurance company without discussing it with the client. The correct answer is C. Advise the client that the discrepancy is minor and proceed with the application as is, assuming the insurer will not notice. Explanation. This scenario presents a professional challenge because the agent is aware of a potential misrepresentation that could lead to a claim denial for the client, impacting their financial security and the agent's professional reputation. The agent must balance their duty to the client with the regulatory requirements of accurate disclosure and underwriting. Careful judgment is required to ensure compliance and uphold ethical standards. The correct approach involves the agent proactively addressing the misrepresentation with the client and explaining the potential consequences. This upholds the agent's fiduciary duty to act in the client's best interest by ensuring accurate information is provided to the insurer, which is a cornerstone of ethical insurance practice and aligns with the principles of fair dealing and transparency expected under state insurance regulations. Accurate disclosure is essential for the insurer to properly assess risk and issue a policy that will respond as intended. An incorrect approach would be to ignore the misrepresentation. This failure to act violates the agent's duty of care and could lead to the insurer rescinding the policy or denying a future claim, causing significant financial harm to the client. Ethically, it is a breach of trust. From a regulatory standpoint, it can be considered aiding and abetting misrepresentation, which carries penalties for the agent. Another incorrect approach would be to proceed with the application without informing the client of the misrepresentation and its implications. This is ethically problematic, as it deprives the client of the opportunity to correct the information and understand the risks associated with an inaccurate application. It also exposes the agent to potential disciplinary action for failing to ensure the accuracy of information submitted to the insurer, a key regulatory expectation. Finally, an incorrect approach would be to advise the client to intentionally misrepresent information to secure coverage. This is a direct violation of insurance laws and ethical codes. It constitutes fraud and can result in severe legal and professional consequences for both the client and the agent, including license revocation and criminal charges. Professionals should approach such situations by prioritizing transparency and client education. The decision-making process involves 1. Identifying the discrepancy and its potential impact. 2. Communicating the issue clearly and empathetically to the client, explaining the regulatory and contractual implications. 3. Guiding the client towards providing accurate information. 4. Documenting all communications and actions taken. This process ensures compliance with regulations and maintains the integrity of the insurance transaction. Question 8. Assessment of a client's understanding of market risk associated with variable life insurance investment options requires the LUTCF professional to: Option A. Provide a detailed explanation of the investment subaccounts, including their historical performance, potential for loss, and how they align with the client's stated risk tolerance and financial objectives, ensuring the client understands the cash value and death benefit are not guaranteed. Option B. Recommend the subaccounts with the highest historical returns, assuming the client desires maximum growth potential regardless of their stated risk tolerance. Option C. Focus on the guaranteed death benefit component of the policy, downplaying the variable nature of the cash value and its associated investment risks. Option D. Emphasize the potential for enhanced cash value growth and death benefit increases, while briefly mentioning that market fluctuations can occur. The correct answer is D. Emphasize the potential for enhanced cash value growth and death benefit increases, while briefly mentioning that market fluctuations can occur. Explanation: this scenario is professionally challenging because variable life insurance policies, by their nature, involve investment risk that is borne by the policy owner. The LUTCF professional's duty is to ensure that the client fully understands this risk and that the chosen investment options align with the client's risk tolerance and financial objectives. Misrepresenting or downplaying these risks, or failing to adequately explain the potential for loss, violates fundamental ethical obligations and regulatory requirements designed to protect consumers. The correct approach involves a thorough and transparent discussion of the investment options available within the variable life insurance policy. This includes clearly explaining that the policy's cash value and death benefit can fluctuate based on the performance of the underlying investment subaccounts. The LUTCF professional must assess the client's risk tolerance, financial goals, and investment knowledge to recommend subaccounts that are suitable. This aligns with the regulatory framework's emphasis on suitability and fair dealing, ensuring that clients are making informed decisions and that the product is appropriate for their circumstances. The Securities and Exchange Commission (SEC) and FINRA regulations, which are foundational to variable product sales, mandate that recommendations be suitable and that all material risks be disclosed. An incorrect approach would be to focus solely on the potential for higher cash value growth without adequately explaining the possibility of investment losses. This misrepresents the product's risk profile and can lead to client dissatisfaction and potential regulatory action. Another incorrect approach is to recommend investment options that are clearly outside the client's stated risk tolerance or financial capacity, even if presented as a way to achieve aggressive growth. This violates the suitability rule, which requires that recommendations be based on the client's individual circumstances. Furthermore, failing to provide or discuss the prospectus, which contains detailed information about the investment options and associated risks, is a significant regulatory failure. The prospectus is a critical disclosure document mandated by securities laws. The professional decision-making process for similar situations should begin with a comprehensive understanding of the client's financial situation, objectives, and risk tolerance. This understanding must then be used to evaluate the suitability of any proposed investment, including the subaccounts within a variable life insurance policy. Transparency regarding all risks and potential outcomes is paramount. If there is any doubt about a client's understanding or the suitability of an investment, the LUTCF professional has an ethical and regulatory obligation to pause, provide further education, or decline to proceed with the sale. Question 9. Upon reviewing a client's financial situation and insurance needs, an agent is considering how to best present available life insurance options. The agent is affiliated with a captive agency that primarily offers products from one major insurer. However, the agent also has access to a limited number of other insurers through a brokerage agreement. The client has expressed a desire for a policy with specific riders that may be more readily available or competitively priced with insurers outside of the captive arrangement. What is the most professional and ethically sound approach for the agent to take in this situation? Option A. Focus solely on the products from the captive insurer that best match the client's stated needs, assuming that the captive insurer's offerings are generally competitive and sufficient. Option B. Present only the products available through the captive agency, highlighting their benefits while downplaying the availability or advantages of other insurers' products. Option C. Advise the client to seek quotes directly from other insurers, as the agent's primary affiliation limits their ability to offer the best solutions. Option D. Conduct a thorough market analysis to identify the most suitable products and riders from various insurers, including those outside the captive arrangement, and present the best options to the client, disclosing any affiliations or compensation structures. The correct answer is B. Present only the products available through the captive agency, highlighting their benefits while downplaying the availability or advantages of other insurers' products. Explanation: this scenario is professionally challenging because it requires an agent to balance the immediate financial incentives of a particular distribution system with their fiduciary duty to the client and adherence to regulatory requirements. The agent must understand how different distribution systems influence product recommendations and potential conflicts of interest. Careful judgment is required to ensure that the client's best interests are always paramount, regardless of the agent's contractual relationship with the insurer. The correct approach involves prioritizing the client's needs and recommending products that are most suitable for their situation, even if this means foregoing a potentially higher commission from a captive or direct rider arrangement. This aligns with the ethical obligation of an agent to act in the client's best interest, a principle reinforced by state insurance regulations that prohibit misrepresentation and require suitability of recommendations. An independent agent, by definition, has access to multiple carriers and products, allowing for a more objective assessment of the market to find the best fit for the client. This independence is a key advantage in fulfilling the agent's duty of care. An incorrect approach would be to exclusively recommend products from a single insurer due to a captive agency agreement, even if those products are not the most competitive or suitable for the client's specific needs. This creates a clear conflict of interest where the agent's compensation structure dictates the recommendation, potentially violating regulations against unfair trade practices and misrepresentation. Similarly, an incorrect approach would be to steer clients towards a direct rider's products solely because of a bonus structure or preferred partnership, without a thorough comparison to other available options. This prioritizes the agent's financial gain over the client's well-being and can lead to regulatory scrutiny for failing to provide adequate advice and product selection. Professionals should employ a decision-making framework that begins with a comprehensive needs analysis of the client. This analysis should then be followed by a diligent search for suitable products across a range of insurers, considering factors like coverage, cost, financial strength of the insurer, and policy features. The agent's compensation should be a secondary consideration to the client's best interests and regulatory compliance. Transparency with the client about the agent's affiliation and the range of products available is also crucial. Question 10. Quality control measures reveal that a loan officer is consistently offering credit life insurance to all borrowers, regardless of their existing coverage or financial circumstances, and is not fully explaining the policy's decreasing death benefit. Which of the following approaches best aligns with regulatory requirements and ethical best practices for an insurance agent in this situation? Option A. Continue offering credit life insurance to all borrowers as a standard product, as it is a common add-on for loans. Option B. Focus on highlighting the peace of mind the insurance provides without detailing specific policy mechanics like the decreasing death benefit. Option C. Conduct a thorough needs assessment with each borrower to determine if credit life insurance is appropriate. Clearly explain all policy features, including the decreasing death benefit and any limitations, and ensure the borrower understands the terms before purchase. Option D. Advise borrowers that credit life insurance is highly recommended to secure their loan and expedite the approval process. The correct answer is C. Conduct a thorough needs assessment with each borrower to determine if credit life insurance is appropriate. Clearly explain all policy features, including the decreasing death benefit and any limitations, and ensure the borrower understands the terms before purchase. Explanation. This scenario presents a professional challenge because it requires an insurance agent to balance the specific needs of a borrower with the regulatory requirements and ethical considerations surrounding credit life insurance. The agent must ensure that the insurance product offered is appropriate for the borrower's situation, and that the sale is conducted in a manner that is both compliant and in the borrower's best interest, avoiding any misrepresentation or undue pressure. The correct approach involves a thorough needs assessment and clear disclosure. This means the agent must first understand the borrower's specific debt obligations and financial situation to determine if credit life insurance is truly necessary and suitable. Crucially, the agent must then provide a clear and comprehensive explanation of the policy's terms, benefits, limitations, and costs, ensuring the borrower fully comprehends what they are purchasing. This aligns with regulatory frameworks that mandate fair dealing, accurate disclosure, and suitability of insurance products. Ethically, it upholds the principle of acting in the client's best interest. An incorrect approach would be to automatically offer credit life insurance to every borrower seeking a loan, regardless of their individual circumstances or existing coverage. This fails to conduct a proper needs assessment and can lead to the sale of unnecessary insurance, which is both a regulatory violation, potentially misrepresentation or unfair sales practices, and an ethical breach. Another incorrect approach is to downplay or omit information about the policy's limitations, such as exclusions or the fact that the coverage decreases as the loan balance is paid down. This constitutes misrepresentation and violates disclosure requirements, undermining the borrower's ability to make an informed decision. A third incorrect approach is to pressure the borrower into purchasing the credit life insurance by implying it is a condition of loan approval or by creating a sense of urgency. This is a coercive sales tactic that violates fair trade practices and ethical standards, as it prevents the borrower from making a free and informed choice. Professionals should approach such situations by prioritizing a client-centric model. This involves a systematic process of understanding the client's needs, evaluating available solutions for suitability, providing transparent and complete information, and allowing the client to make an uncoerced decision. Adherence to regulatory guidelines and ethical principles should be the foundation of every client interaction. Question 11. Performance analysis shows that a long-term universal life insurance policy client has recently experienced a significant increase in income and is concerned about outliving their retirement savings. They have contacted their agent requesting to increase their death benefit and reduce their premium payments to free up cash flow for other investments. Which of the following represents the most appropriate course of action for the agent? Option A. Immediately process the request to increase the death benefit and reduce the premium, assuming the client has a clear understanding of the policy's cash value and cost of insurance implications. Option B. Inform the client that reducing premiums on a universal life policy will automatically decrease the death benefit and cash value, and advise them to maintain current premium levels. Option C. Suggest the client surrender the universal life policy and reinvest the cash value into a more aggressive investment vehicle that may offer higher returns. Option D. Advise the client that increasing the death benefit will necessitate an increase in premiums, not a reduction, and schedule a comprehensive policy review to discuss their current financial situation and long-term goals. The correct answer is D. Advise the client that increasing the death benefit will necessitate an increase in premiums, not a reduction, and schedule a comprehensive policy review to discuss their current financial situation and long-term goals. Explanation. This scenario presents a common implementation challenge for life insurance agents, particularly with flexible premium adjustable death benefit policies like universal life. The challenge lies in balancing the client's evolving financial circumstances and risk tolerance with the policy's inherent flexibility and the agent's fiduciary duty to provide suitable recommendations. The agent must navigate potential misunderstandings about policy performance, the impact of premium payments on cash value and death benefit, and the long-term implications of policy adjustments. The correct approach involves a proactive and transparent review process. This includes thoroughly assessing the client's current financial situation, understanding any changes in their needs or objectives, and clearly explaining the implications of any proposed policy adjustments. This approach aligns with the Life Underwriter Training Council Fellow, LUTCF, curriculum's emphasis on client-centric advice and ethical conduct. Specifically, it adheres to regulations requiring agents to act in the best interest of the client, ensuring that recommendations are suitable based on the client's profile, and that all policy features and potential outcomes are clearly communicated. This proactive engagement prevents policy lapse, underfunding, or unintended consequences that could harm the client's financial security. An incorrect approach would be to simply adjust the policy based on the client's immediate request without a comprehensive review. This fails to uphold the agent's duty to assess suitability and could lead to a policy that no longer meets the client's long-term needs or financial capacity. Another incorrect approach is to assume the client fully understands the policy's mechanics and the impact of their requested changes. This oversight can result in misaligned expectations and potential dissatisfaction or financial detriment for the client. A third incorrect approach is to prioritize the sale of additional riders or policy enhancements without a clear demonstration of their necessity and benefit to the client's specific situation, potentially leading to unnecessary costs and a violation of suitability standards. Professional decision-making in such situations requires a systematic process. First, actively listen to and understand the client's stated needs and concerns. Second, conduct a thorough needs analysis, considering the client's current financial status, objectives, and risk tolerance. Third, analyze the existing policy's performance and how proposed changes will affect its cash value, death benefit, and cost of insurance. Fourth, clearly communicate the implications of all options, including the recommended course of action and potential alternatives, ensuring the client can make an informed decision. Finally, document all discussions and decisions to maintain a clear record of the advisory process. Question 12. Implementation of a supplemental health insurance recommendation for a client enrolled in a preferred provider organization (PPO) plan requires the life underwriter to accurately convey the PPO's operational framework. Which of the following best represents the professional and regulatory best practice in this situation? Option A. Advise the client to switch to a different type of health plan that offers lower out-of-pocket costs without fully explaining the PPO's network benefits or the supplemental policy's role. Option B. Focus exclusively on the benefits of the supplemental insurance policy, assuming the client fully understands the intricacies of their PPO plan and its out-of-network cost structure. Option C. Emphasize the broad network access of the PPO and explain how supplemental insurance can help offset deductibles and copayments, while clearly stating that using out-of-network providers will result in higher out-of-pocket expenses, even with supplemental coverage. Option D. Highlight the cost savings of the PPO and assure the client that supplemental insurance will cover all costs associated with using any provider, regardless of network status. The correct answer is C. Emphasize the broad network access of the PPO and explain how supplemental insurance can help offset deductibles and copayments, while clearly stating that using out-of-network providers will result in higher out-of-pocket expenses, even with supplemental coverage. Explanation. This scenario is professionally challenging because it requires the life underwriter to balance client needs with the complexities of health insurance plan structures, specifically preferred provider organizations, PPO. The underwriter must ensure the client understands the implications of network restrictions and out-of-pocket costs associated with PPO plans, particularly when recommending supplemental health insurance. Misrepresenting or oversimplifying these aspects can lead to significant client dissatisfaction and potential regulatory scrutiny. The correct approach involves clearly explaining to the client that a PPO plan offers flexibility in choosing providers, but incurs higher costs when out of network. It emphasizes that supplemental health insurance, while beneficial, does not eliminate the PPO's inherent cost structure for out-of-network care. This approach aligns with the ethical duty of utmost good faith and the regulatory requirement for clear and accurate disclosure of policy features and limitations. Providing a comprehensive overview of how the PPO operates and how supplemental insurance complements it, without creating false expectations, is paramount. An incorrect approach that focuses solely on the benefits of supplemental insurance without adequately explaining the PPO's out-of-network cost implications fails to provide a complete picture. This can mislead the client into believing their out-of-pocket expenses will be significantly lower than they actually will be when using non-preferred providers. This omission constitutes a failure to disclose material information, violating ethical standards and potentially regulatory mandates for transparency. Another incorrect approach that suggests supplemental insurance will cover all out-of-network costs associated with a PPO plan is factually inaccurate and misleading. This misrepresentation creates a false sense of security and can lead to substantial financial burdens for the client. It directly contravenes the principle of providing accurate product information and can result in claims disputes and regulatory action. The professional decision-making process for similar situations should involve a thorough understanding of both the primary health insurance plan, in this case, a PPO, and any proposed supplemental coverage. The underwriter must prioritize clear, honest, and comprehensive communication, ensuring the client grasps the nuances of network providers, cost-sharing mechanisms, and the specific benefits and limitations of each product. This involves active listening to the client's concerns and tailoring the explanation to their level of understanding, always adhering to regulatory disclosure requirements and ethical obligations. Question 13. Which approach would be most appropriate for a life insurance agent when discussing the accidental death, waiver of premium, and guaranteed insurability riders with a client who has expressed concerns about affordability and the complexity of policy features? Option A. Suggest that the client add all available riders to ensure maximum protection and address any questions about cost or complexity only if the client explicitly asks. Option B. Prioritize explaining how each rider can enhance the policy's value and address potential future needs, while also clearly outlining the associated costs and any potential complexities in their operation. Option C. Focus on the potential for increased coverage and benefits offered by the riders, downplaying the additional premiums and any intricate details of their activation or termination. Option D. Recommend the riders as standard additions that most clients find beneficial, without delving into the specifics of how they directly align with the client's unique financial situation or concerns. The correct answer is B. Prioritize explaining how each rider can enhance the policy's value and address potential future needs, while also clearly outlining the associated costs and any potential complexities in their operation. Explanation. This scenario is professionally challenging because it requires the life insurance agent to balance the client's immediate financial concerns with the long-term implications of their insurance coverage, all while adhering to regulatory requirements and ethical obligations. The agent must not only understand the technical aspects of the riders, but also how they impact the client's overall financial plan and risk management strategy. The correct approach involves a thorough needs analysis that prioritizes the client's stated financial goals and risk tolerance, then explains how specific riders can address those needs. This aligns with the regulatory framework for life insurance sales, which mandates that recommendations be suitable for the client's circumstances and that agents act in the client's best interest. The agent must clearly articulate the benefits, costs, and potential limitations of each rider, ensuring the client makes an informed decision. This approach upholds the ethical duty of care and transparency expected of licensed professionals. An incorrect approach that focuses solely on upselling riders without a clear connection to the client's needs is ethically problematic and potentially violates suitability regulations. Agents have a responsibility to recommend products and features that genuinely benefit the client, not just to increase commission. Another incorrect approach that downplays the costs or long-term implications of riders, or misrepresents their benefits, constitutes a failure of ethical conduct and could lead to regulatory violations related to misrepresentation and deceptive practices. Agents must provide accurate and complete information. A further incorrect approach that ignores the client's expressed concerns about affordability or complexity and pushes riders regardless demonstrates a lack of client centricity and fails to meet the standard of care. Professional decision-making in such situations requires a systematic process. First, actively listen to and understand the client's situation, goals, and concerns. Second, conduct a comprehensive needs analysis. Third, identify suitable product features and riders that address those needs. Fourth, clearly and accurately explain the benefits, costs, and limitations of each recommendation. And finally, ensure the client fully understands and agrees with the proposed coverage. Question 14. The analysis reveals that Mr. Henderson, a 55-year-old client, is seeking guidance on his retirement planning. He has expressed a desire to maintain his current lifestyle, which includes frequent international travel and dining out, and has provided a list of his current assets and liabilities. He is concerned about outliving his savings. Which of the following approaches best addresses Mr. Henderson's retirement needs analysis in a manner consistent with regulatory and ethical standards for a Life Underwriter Training Council Fellow? Option A. Projecting Mr. Henderson's current annual expenses forward to retirement, assuming a modest inflation rate, and recommending a portfolio allocation based on his stated age and a general market average for his risk tolerance. Option B. Conducting a detailed lifestyle assessment to understand Mr. Henderson's specific retirement aspirations, including the frequency and cost of his desired travel and dining, and then developing a personalized retirement income strategy that considers his risk tolerance, time horizon, and potential healthcare needs. Option C. Focusing primarily on maximizing Mr. Henderson's current savings growth through aggressive investment vehicles, assuming that higher returns will automatically cover any future shortfalls in his retirement income. Option D. Providing Mr. Henderson with a generic retirement savings calculator and advising him to input his own data, with the understanding that he will manage his own investment decisions based on the output. The correct answer is A. Projecting Mr. Henderson's current annual expenses forward to retirement, assuming a modest inflation rate, and recommending a portfolio allocation based on his stated age and a general market average for his risk tolerance. Explanation. This scenario presents a professional challenge because retirement needs analysis is not a static calculation, but a dynamic process requiring ongoing client engagement and adaptation to changing life circumstances and economic conditions. The challenge lies in moving beyond a simple projection of income needs to a comprehensive understanding of the client's evolving lifestyle, health, and financial goals, while adhering to regulatory standards for suitability and client best interest. Careful judgment is required to balance the client's stated desires with realistic financial projections and to ensure the recommended strategies are both appropriate and sustainable. The correct approach involves a holistic review of the client's current financial situation, including all assets, liabilities, and income sources, alongside a detailed exploration of their anticipated retirement lifestyle, including desired spending levels, travel plans, and potential healthcare costs. This approach emphasizes understanding the client's risk tolerance and time horizon to recommend suitable investment and income strategies that align with their long-term objectives. Regulatory justification stems from the principles of suitability and acting in the client's best interest, which mandate that recommendations be based on a thorough understanding of the client's financial situation and objectives. Ethical considerations further support this approach by requiring transparency and a commitment to helping the client achieve their retirement goals responsibly. An incorrect approach that focuses solely on projecting current spending habits into retirement fails to account for potential changes in lifestyle, inflation, or unexpected expenses, potentially leading to underestimation of needs and inadequate planning. This violates the principle of suitability by not fully assessing the client's circumstances. Another incorrect approach that prioritizes aggressive investment strategies without a thorough assessment of the client's risk tolerance or time horizon could expose them to undue risk, jeopardizing their retirement security and contravening the client's best interest. Furthermore, an approach that relies on generic retirement calculators without personalized input or consideration of unique client factors lacks the depth required for effective planning and may not meet regulatory expectations for individualized advice. Professional decision-making in similar situations requires a structured process. First, gather comprehensive client information. Second, analyze this information to identify needs, goals, and risks. Third, develop and present tailored strategies. And fourth, monitor and adjust the plan as circumstances change. This iterative process ensures that advice remains relevant and effective throughout the client's journey toward retirement. Question 15. Governance review demonstrates that an insurance agent has been providing clients with a generalized overview of insurance providers, often conflating the operational and ownership distinctions between different types of insurers. When advising a prospective client about policy options, which of the following approaches best upholds the agent's ethical and regulatory obligations regarding the accurate representation of insurance company types? Option A. Emphasize that all insurance companies operate similarly, focusing primarily on the policy's death benefit and cash value accumulation features, regardless of the insurer's ownership structure. Option B. Focus on the financial strength ratings of all insurers, asserting that these ratings are the sole determinant of an insurer's suitability, irrespective of its organizational type. Option C. Highlight the potential for high dividend payouts from all types of insurance companies, suggesting that policyholder dividends are a common feature across the industry. Option D. Clearly differentiate between mutual, stock, and fraternal insurance companies, explaining their respective ownership structures, policyholders, shareholders, or members, and how profits or surplus are typically distributed or utilized. The correct answer is A. Emphasize that all insurance companies operate similarly, focusing primarily on the policy's death benefit and cash value accumulation features, regardless of the insurer's ownership structure. Explanation. This scenario presents a professional challenge because an insurance agent must accurately represent the fundamental nature of insurance companies to prospective clients. Misrepresenting the ownership structure and profit distribution mechanisms of mutual, stock, and fraternal insurers can lead to client confusion, distrust, and potentially regulatory scrutiny. Understanding these distinctions is crucial for ethical sales practices and ensuring clients make informed decisions aligned with their financial goals and values. The correct approach involves clearly and accurately distinguishing between mutual, stock, and fraternal insurance companies, emphasizing their ownership structures and how profits are handled. For mutual companies, it is essential to explain that policyholders are the owners and may receive dividends. For stock companies, it is important to state that shareholders are the owners and profits may be distributed as dividends to them or reinvested. For fraternal organizations, the focus should be on their charitable or benevolent purpose, and that any surplus may be used to further these aims or returned to members. This approach aligns with regulatory requirements for fair dealing and accurate representation, ensuring clients understand who benefits from the company's operations and how their premiums are utilized. An incorrect approach would be to broadly state that all insurance companies are the same and focus solely on policy benefits without clarifying the ownership structure. This fails to meet the ethical obligation of providing complete and accurate information, potentially misleading clients about the nature of their insurer and their rights as policyholders. Another incorrect approach would be to overemphasize the potential for dividends from stock companies, implying they are similar to mutual companies in this regard, which is a misrepresentation of their profit distribution model. Similarly, misrepresenting fraternal organizations as purely profit-driven entities, similar to stock companies, would be inaccurate and fail to acknowledge their unique charitable mission. These misrepresentations violate principles of honesty and transparency mandated by insurance regulations. Professionals should approach such situations by first understanding the core differences between the types of insurers. When discussing these with clients, they should tailor their explanations to the client's level of understanding, using clear and concise language. The decision-making process should prioritize accuracy, transparency, and the client's best interest, ensuring all statements are verifiable and compliant with regulatory guidelines regarding fair advertising and sales practices. Question 16. The risk matrix shows a potential gap in client education regarding health savings accounts, HSA, and their integration with life insurance planning. A client who is self-employed and seeking to manage healthcare costs while also considering long-term financial security has asked for guidance on how an HSA might complement their overall financial strategy. Which of the following approaches best optimizes the underwriter's role in this situation, adhering strictly to LUTCF and U.S. regulatory frameworks? Option A. Explain the general concept of HSAs, their eligibility requirements, how funds can be used for qualified medical expenses, and the potential tax advantages, while advising the client to consult with a tax professional for specific tax advice and a financial advisor for investment strategies related to the HSA balance. Option B. Provide detailed projections on how the HSA funds could grow over time through specific investment vehicles, and offer advice on the optimal tax strategies for withdrawing funds in retirement, based on the underwriter's understanding of tax laws. Option C. Recommend specific high-yield savings accounts or mutual funds for the HSA, based on the underwriter's personal investment preferences, and explain how these choices will maximize tax benefits. Option D. Advise the client that HSAs are primarily for medical expenses and have no bearing on life insurance planning. Therefore, no further discussion or information is necessary. The correct answer is A. Explain the general concept of HSAs, their eligibility requirements, how funds can be used for qualified medical expenses, and the potential tax advantages, while advising the client to consult with a tax professional for specific tax advice and a financial advisor for investment strategies related to the HSA balance. Explanation. This scenario is professionally challenging because it requires the life underwriter to navigate the complex interplay between health insurance, investment vehicles, and tax regulations, all while acting in the client's best interest. The underwriter must ensure that any recommendation regarding health savings accounts, HSA, is not only suitable for the client's health needs, but also compliant with IRS regulations and ethical standards of practice. The core challenge lies in providing accurate, unbiased information about HSAs without engaging in prohibited activities like providing tax or investment advice, which fall outside the scope of a life underwriter's license. The correct approach involves educating the client about the general features and benefits of HSAs, emphasizing their role as a savings vehicle for qualified medical expenses and their potential tax advantages. This approach correctly focuses on the informational and educational role of the underwriter, staying within the bounds of their licensing and expertise. It aligns with regulatory frameworks that permit agents to explain product features and general benefits, while clearly directing the client to qualified professionals, tax advisors, financial planners, for specific tax or investment advice. This upholds the ethical duty to avoid misrepresentation and to ensure clients receive advice from appropriately licensed individuals. An incorrect approach that involves providing specific tax implications or investment recommendations for the HSA funds is professionally unacceptable. This constitutes practicing as a tax advisor or investment advisor without the requisite licenses and certifications, which is a direct violation of state insurance regulations and federal tax laws. Such actions expose both the client and the underwriter to significant legal and financial risks, including penalties and fines. Furthermore, it breaches the ethical obligation to act within one's scope of competence and to avoid conflicts of interest or the appearance thereof. Another incorrect approach, which is to dismiss HSAs entirely without proper explanation, fails to meet the professional obligation to inform clients about relevant financial tools that could benefit them. While not illegal, it represents a failure in due diligence and client service, potentially leading to suboptimal financial planning for the client. The professional decision-making process for similar situations should involve a clear understanding of one's licensing limitations. When a client inquires about areas outside an underwriter's expertise, such as specific tax advice or investment strategies, the professional response should be to provide general information about the product's features, and then to recommend consulting with a qualified professional in that specific field. This ensures the client receives accurate and appropriate advice while protecting the underwriter from regulatory violations and ethical breaches. Question 17. Compliance review shows that a life insurance producer, licensed in multiple states, is operating under the assumption that federal regulations dictate all aspects of their producer licensing and market conduct, regardless of the state in which they are transacting business. Which approach best aligns with the regulatory framework governing the insurance industry in the United States? Option A. The producer should follow the regulations of the state where the insurance company they represent is headquartered, as this state has oversight over its domiciled insurers. Option B. The producer must adhere to the licensing and market conduct regulations of each individual state in which they are licensed and transact business, as insurance regulation is primarily a state function. Option C. The producer should prioritize federal regulation, as they provide a uniform standard that supersedes state-specific rules for all insurance producers. Option D. The producer should consult federal agencies like the SEC for guidance on all licensing and market conduct matters to ensure national compliance. The correct answer is B. The producer must adhere to the licensing and market conduct regulations of each individual state in which they are licensed and transact business, as insurance regulation is primarily a state function. Explanation: this scenario is professionally challenging because it requires an insurance professional to navigate the complex interplay between state and federal regulations governing the insurance industry, specifically concerning producer licensing and market conduct. The core of the challenge lies in accurately identifying which regulatory body has primary authority over specific aspects of an insurance business. A failure to do so can lead to significant legal penalties, reputational damage, and a loss of consumer trust. Careful judgment is required to distinguish between areas where states hold exclusive jurisdiction and those where federal oversight might apply or supplement state authority. The correct approach involves recognizing that, under the McCarran-Ferguson Act, insurance regulation is primarily a state function. Therefore, a producer's licensing, appointment with insurers, and adherence to state-specific market conduct rules are governed by the laws of the state in which they are licensed and transact business. This approach prioritizes state-level compliance, which is the foundational regulatory framework for insurance producers in the United States. Adhering to this principle ensures that the producer operates within the established legal boundaries set by each state, preventing violations of state insurance codes and regulations. An incorrect approach would be to assume that federal agencies, such as the Securities and Exchange Commission, SEC, or the Department of Justice, have direct authority over the day-to-day licensing and market conduct of a life insurance producer, absent specific circumstances like the sale of variable products, which involve securities regulations. This is incorrect because the McCarran-Ferguson Act explicitly reserves the business of insurance to the states, while federal laws can impact insurance in certain areas, e.g., antitrust, consumer protection in specific contexts. They do not supersede the primary state-based licensing and market conduct regulatory authority for traditional life insurance products. Another incorrect approach would be to solely rely on the regulations of the state where the insurer is headquartered, rather than the state where the producer is licensed and actively transacting business. This fails to acknowledge that licensing and market conduct are tied to the location of the producer's activities and the consumer's location, not just the insurer's domicile. The professional decision-making process for similar situations should begin with a clear understanding of the McCarran-Ferguson Act and its implications for insurance regulation. Professionals must then identify the specific activity in question, e.g., licensing, advertising, claims handling, and determine the relevant jurisdiction. For producer licensing and market conduct, the primary jurisdiction is almost always the state where the producer is licensed and operates. If the product involves securities, e.g., variable annuities, then federal securities laws and FINRA regulations also apply, requiring a dual compliance approach. When in doubt, consulting with legal counsel specializing in insurance law or regulatory compliance is a critical step to ensure accurate interpretation and adherence to all applicable laws. Question 18. Process analysis reveals that a life underwriter is meeting with a prospective client who has a high-deductible health plan, HDHP. The client expresses interest in purchasing life insurance to provide for their family. Which of the following approaches best aligns with regulatory compliance and ethical sales practices when discussing life insurance options in conjunction with the client's HDHP? Option A. Advise the client that the existence of an HDHP generally makes a specific type of life insurance policy, e.g., Term life, inherently more or less suitable without a detailed assessment of the client's individual financial situation and risk tolerance. Option B, proceed with a standard life insurance needs analysis and recommendation. Assuming the client's HDHP is a separate financial matter that does not impact their ability to afford life insurance premiums or their overall financial risk. Option C, explain the features of the HDHP, including its lower premium and higher out-of-pocket costs, and then conduct a life insurance needs analysis that considers the client's overall financial capacity to manage both potential medical expenses and life insurance premiums. Option D, emphasize that the lower premium of the HDHP frees up significant funds, allowing for the recommendation of a substantially larger life insurance policy without a detailed discussion of the HDHP deductible and out-of-pocket medical expenses. The correct answer is C. Explain the features of the HDHP, including its lower premium and higher out-of-pocket costs, and then conduct a life insurance needs analysis that considers the client's overall financial capacity to manage both potential medical expenses and life insurance premiums. Explanation. This scenario is professionally challenging because it requires the life underwriter to navigate the complexities of high-deductible health plans, HDHP, and their interaction with life insurance recommendations, all while adhering strictly to the regulatory framework governing life insurance sales in the United States, as relevant to the LUTCF designation. The underwriter must ensure that any recommendations are suitable for the client's financial situation and insurance needs, without misrepresenting the nature or benefits of an HDHP or its impact on life insurance planning. The correct approach involves accurately explaining the characteristics of an HDHP, including its lower premiums and higher out-of-pocket costs, and then assessing how these factors might influence the client's ability to afford life insurance premiums or their overall financial capacity to manage potential medical expenses. This approach prioritizes client education and suitability, aligning with regulatory requirements that mandate agents act in the client's best interest and provide accurate, non-misleading information. The justification lies in the principle of suitability, which requires agents to have a reasonable basis to believe a recommended product is suitable for the client's financial situation, needs, and objectives. Misrepresenting an HDHP or failing to consider its financial implications when recommending life insurance would violate this principle and potentially lead to regulatory action. An incorrect approach that focuses solely on the lower premium of an HDHP as a justification for recommending a higher face amount of life insurance, without fully explaining the associated out-of-pocket medical costs, is ethically and regulatorily flawed. This misrepresents the client's true financial picture and could lead to an unaffordable life insurance policy or a situation where the client cannot manage both the HDHP deductibles and the life insurance premiums. Another incorrect approach, which is to ignore the HDHP entirely and proceed with a standard life insurance needs analysis without acknowledging the client's current health coverage, fails to provide a comprehensive and tailored recommendation. This oversight can lead to unsuitable recommendations that do not account for the client's existing financial commitments and potential future medical expenses. Finally, an approach that suggests the HDHP structure inherently makes a specific type of life insurance more or less suitable without a detailed client-specific analysis is also problematic, as it relies on generalizations rather than individual circumstances. Professional decision-making in such situations requires a thorough understanding of the client's current financial landscape, including existing insurance policies and health plan structures. The underwriter must then conduct a comprehensive needs analysis, considering the client's income, expenses, dependents, and financial goals. Recommendations for life insurance must be directly linked to these identified needs and the client's demonstrated capacity to afford the premiums and manage potential out-of-pocket costs associated with their HDHP. Transparency and clear communication about all aspects of the client's financial situation and the recommended products are paramount. Question 19. Consider a scenario where a client, a self-employed graphic designer earning $80,000 annually, expresses a strong desire for a disability income insurance policy that will provide a substantial monthly benefit to cover their living expenses. They mention having a modest emergency fund, but are primarily concerned about maintaining their lifestyle if they become unable to work. The underwriter has access to policies that can offer up to 70% of the client's gross income as a monthly benefit, with various waiting periods. What is the most appropriate approach for the underwriter to take in recommending a policy? Option A. Conduct a detailed needs analysis to determine the client's essential monthly expenses and compare this to their current income. Then recommend a benefit amount and waiting period that aligns with these findings and the client's financial resources. Option B. Recommend a policy with a benefit amount that replaces 70% of the client's gross income and a 30-day waiting period, as this maximizes the immediate financial protection the client desires. Option C. Advise the client to select the shortest possible waiting period to ensure immediate income replacement, regardless of their emergency fund status. Option D. Focus on selling a policy with the highest possible monthly benefit, explaining that this provides the greatest peace of mind for the client. Correct answer is B. Recommend a policy with a benefit amount that replaces 70% of the client's gross income and a 30-day waiting period, as this maximizes the immediate financial protection the client desires. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the life underwriter to balance the client's immediate financial needs with the long-term implications of disability income insurance coverage. Misinterpreting the client's true needs or failing to adequately explain policy limitations can lead to significant client dissatisfaction and potential regulatory scrutiny. The underwriter must demonstrate a thorough understanding of disability income insurance principles and their application to individual circumstances, adhering strictly to the regulatory framework governing such advice. Correct approach analysis. The correct approach involves a comprehensive needs analysis that considers the client's current income, essential living expenses, and potential future financial obligations. This analysis should then be used to determine an appropriate benefit amount and waiting period that aligns with the client's ability to manage without their income. Specifically, the underwriter should explain that the benefit amount should aim to replace a significant portion of the client's income, but not exceed it, to maintain the incentive to return to work. The waiting period should be chosen based on the client's existing financial resources, e.g., savings, emergency fund, to cover expenses during the initial period of disability. This approach is ethically sound and aligns with regulatory expectations that advisors act in the client's best interest, providing suitable recommendations based on a thorough understanding of their financial situation and the product's features and limitations. Incorrect approaches analysis. Recommending the maximum possible benefit without a detailed needs analysis fails to ensure suitability. This approach prioritizes policy sale over client welfare, potentially leading to overinsurance, which can disincentivize return to work and may be viewed as an unethical practice. It also neglects the regulatory requirement to provide advice that is in the client's best interest. Suggesting the shortest possible waiting period without assessing the client's financial reserves is also problematic. While this might seem beneficial for immediate income replacement, it could lead to unnecessarily higher premiums for the client. Furthermore, it bypasses a crucial step in tailoring the policy to the client's specific financial resilience, which is a key component of suitability. Focusing solely on the client's stated desire for a high monthly benefit without exploring the implications of the benefit percentage relative to their current income is a significant oversight. This can result in a policy that replaces more income than the client actually needs, increasing costs and potentially violating the principle of providing coverage that is reasonably related to the client's financial loss. This demonstrates a failure to conduct a proper needs analysis and provide advice that is truly in the client's best interest. Professional reasoning. Professionals should approach this situation by first conducting a thorough fact-finding interview to understand the client's income, expenses, existing financial resources, and risk tolerance. This information forms the basis for a personalized needs analysis. The underwriter should then explain the various policy features, including benefit amounts, waiting periods, and benefit durations, in the context of the client's specific situation. Recommendations should be clearly justified based on the needs analysis and presented to the client, allowing them to make an informed decision. This process ensures compliance with best practices and regulatory requirements for providing suitable insurance advice. Question 20. Governance review demonstrates that client has expressed a strong desire for an immediate annuity to generate income starting now, citing a need for predictable cash flow. However, the client also indicates a limited understanding of the product's long-term commitment and potential penalties for early withdrawal. Which of the following approaches best aligns with regulatory requirements and ethical obligations for a life underwriter? Option A. Recommend a different type of investment that offers immediate income but is more liquid, even if it means foregoing the sale of the annuity. Option B. Conduct a comprehensive needs analysis to understand the client's overall financial situation, risk tolerance, and liquidity needs, and then determine if an immediate annuity is the most suitable solution, presenting alternatives if appropriate. Option C. Proceed with the sale of an immediate annuity, ensuring the client understands the income stream will begin immediately, and address any questions about surrender charges if they arise. Option D. Explain the immediate annuity's features and benefits, focusing on the immediate income, and advise the client to consult with a financial advisor before making a decision. The correct answer is C. Proceed with the sale of an immediate annuity, ensuring the client understands the income stream will begin immediately, and address any questions about surrender charges if they arise. Explanation. This scenario presents a professional challenge because it requires the life underwriter to balance the client's immediate need for income with the regulatory obligation to ensure suitability. The client's stated desire for immediate income from an annuity, coupled with their limited understanding of the product's long-term implications and potential surrender charges, creates a situation where a simple sale could lead to a suboptimal outcome for the client and potential regulatory scrutiny. Careful judgment is required to ensure the client's best interests are met within the bounds of regulatory compliance. The correct approach involves a thorough needs analysis that goes beyond the client's initial request. This includes understanding the client's overall financial situation, risk tolerance, liquidity needs, and the specific purpose of the income stream. By exploring these factors, the underwriter can determine if an immediate annuity is truly the most suitable product, or if alternative solutions might better address the client's objectives while mitigating potential downsides like surrender charges or illiquidity. This aligns with the regulatory framework's emphasis on suitability, which mandates that recommendations must be appropriate for the client's individual circumstances and objectives. Ethical practice dictates that the underwriter acts as a fiduciary, prioritizing the client's welfare above all else. An incorrect approach would be to proceed with the sale of an immediate annuity solely based on the client's stated desire for immediate income, without conducting a comprehensive suitability assessment. This fails to meet the regulatory requirement of ensuring the product is appropriate for the client's specific needs and financial situation. It also violates ethical principles by potentially exposing the client to unnecessary risks, such as significant surrender charges if they later need access to the principal, or by recommending a product that may not be the most efficient way to meet their long-term income goals. Another incorrect approach is to downplay or omit information about surrender charges and the long-term nature of annuity contracts. This constitutes a failure to provide full and fair disclosure, which is a cornerstone of regulatory compliance and ethical conduct. Clients have a right to understand all material aspects of a product, including its limitations and potential costs, before making a decision. Failing to do so can lead to misinformed choices and potential disputes. A third incorrect approach involves pushing the client towards a specific product without adequately exploring alternatives. While immediate annuities can be suitable in certain situations, a responsible underwriter should always consider a range of options that might achieve similar objectives with different risk/reward profiles or cost structures. Failing to do so suggests a potential bias or a lack of diligence in fulfilling the duty to advise. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's stated needs and objectives. 2. Conduct a comprehensive needs analysis to uncover underlying financial circumstances, risk tolerance, and liquidity requirements. 3. Educate the client thoroughly on the features, benefits, risks, and costs of any recommended product, including surrender charges and long-term implications. 4. Explore and present suitable alternative solutions that may also meet the client's objectives. 5. Document the entire process, including the needs analysis, client discussions, product recommendations, and the client's final decision. 6. Ensure all recommendations and actions are compliant with current regulations and ethical standards.